A 15% drop right after earnings usually means one of two things. Either something went seriously wrong, or the market completely misread the story. In the case of SoFi Technologies, it's not that obvious. So let's go through the report quickly, and then see what the valuation actually says. So starting with the report itself, SoFi has actually built a pattern of consistently beating expectations, often quite meaningfully. And this quarter was still solid. The company did beat across the board. But the key difference is that the magnitude of the beat has clearly moderated. On revenue, we're looking at roughly a 3.6% beat versus consensus, which is still good, still respectable. However, on the bottom line, EPS came in largely in line with expectations, with only about a 0.5% surprise. So overall, nothing negative here. The business is still performing well, but the report lacked the kind of substantial over-delivery that investors had gotten used to in previous quarters. User growth remains very strong here. SoFi added 35% more new members year over year, which is still a very solid pace of expansion. On top of that, product adoption actually accelerated even further, with total products growing 39% year over year. So both metrics together point to one thing. The platform is still scaling at a healthy and pretty consistent rate, even if the earnings beat itself wasn't as aggressive as in previous quarters. Adjusted net revenue also continued to show strong momentum, coming in at 41% year-over-year growth in the first quarter. On top of that, profitability is also moving in the right direction. Adjusted net income margin for the quarter came in at 15%, which is an improvement compared to around 13% in 2025. So not only is the company still growing at a high rate, but it's also gradually expanding profitability, which is exactly what you want to see at this stage of the cycle. Looking forward, the guidance is also solid. For the next quarter, SoFi expects around 30% growth in adjusted net revenue, with adjusted net income margin of approximately 12 to 13%. And the full year 2026 outlook remains strong as well, still implying roughly 30% revenue growth. On the earnings side, EPS is expected to reach around 60 cents, which would represent about 54% growth year over year. So overall, this is still a company guiding to high growth and improving profitability at the same time, which is why the market reaction here feels a bit disconnected from the fundamentals, because at least based on the numbers, this was a good quarter with solid forward guidance, not something that would normally justify a sharp sell-off. So the real question is not this quarter, it's how the business is growing over time. Let's take a look at past performance and what's expected going forward. SoFi is still growing at a very strong pace. Revenue grew 35.5% in 2025, following 27.8% in 2024. So the acceleration is clearly there. And the scale of that growth is pretty remarkable. Since 2020, revenue has gone from roughly $565 million to $3.6 billion in 2025. Which is exceptional. And importantly, the growth story doesn't end here. Looking forward, analysts are still expecting 20% plus annual growth over the next 3 years. Yes, that's a step down from the earlier hypergrowth phase, but even at those levels, this is still a very high growth business by public market standards. So while growth is clearly strong, the real question is how that translates into profitability. Looking at the numbers, both net margin and return on equity are improving overall, but the picture is not entirely linear. For 2025, net margin came in at around 13.4%, while on a last 12 months basis, it's closer to 14.8%. So there is progress, but also some volatility compared to prior periods. At the same time, management is guiding to roughly 18% net margin for full year 2026, which implies a meaningful step up in profitability from here. On the return side, ROE has been improving as well, but it still remains relatively low at around 5.4% on an LTM basis. So the key takeaway is that profitability is clearly moving in the right direction, but the business is still in the early stages of reaching its full earnings potential. That said, there is one real issue here, and that's share dilution. In 2025, the share count increased by roughly 16%, which is very significant. And even in 2024, it was up about 12.2%. Now, to be fair, this is partly a function of growth. The company is scaling, investing, and raising capital to support that expansion. But from a shareholder perspective, this is still a meaningful headwind, because even if the business is growing and becoming more profitable, a large portion of that value is being spread across a rapidly increasing number of shares. So ultimately, the key question going forward is whether SoFi can slow down dilution over time and allow more of that growth to actually translate into per-share returns. Now, looking at valuation, SoFi Technologies is currently trading at around 36.5x earnings. On the surface, that doesn't look particularly expensive, especially given the high growth expectations. And historically, the stock has traded at meaningfully higher multiples, so relative to its own range, this is not stretched. However, it's important to keep in mind what kind of business this actually is. SoFi is essentially a hybrid between a fintech platform and a bank, and traditional banks typically trade closer to 15 to 20x earnings, which means that as the company matures, there is a reasonable argument that the multiple will gradually normalize lower, even if the business continues to perform well. So the setup here is not just about growth, it's about whether that growth can outpace potential multiple compression over time. When it comes to the DCF, All of the key assumptions are displayed on the screen, so I won't go through each of them line by line. What I do want to highlight, however, is the relatively conservative discount rate I used. Across the three scenarios, my WACC ranges from 10% to 12%, which is on the higher end and reflects both execution risk and the current rate environment. At the same time, on the operating side, the model does assume a meaningful improvement in profitability. By year 10, EBIT margins reach 26%, 28%, and 30% across the bear, base, and bull cases respectively. So the framework clearly implies that SoFi Technologies evolves into a much more profitable business over time. Based on these assumptions, the model gives a weighted target price of $19.93 per share, which implies about 23.8% upside from the current price of roughly $16. Looking at the scenario breakdown, in the bull case, the valuation reaches $29.05 per share, representing an 83.5% upside. On the other hand, in the bear case, the valuation comes down to $12.68, which implies around 21% downside. So overall, the DCF framework suggests that at current levels, the stock appears moderately undervalued, with a skew that leans more to the upside than the downside. Now, if we look at the DCF using an exit multiple approach, the picture becomes a bit more return-driven. I'm applying EV to EBITDA exit multiples of 20x, 22x, and 25x across the bear, base, and bull cases. Under these assumptions, the model implies a weighted target price of $33.39 in 5 years, which translates into a 15.7% compound annual return. And that's already a pretty solid outcome on a risk-adjusted basis. Breaking it down further, even in the bear case, the model still delivers a 9.9% CAGR, which is broadly in line with long-term market averages. In the bull case, that number goes up to 21.5%, which is clearly a much stronger outcome. That said, this approach is naturally very sensitive to the exit multiple you assume. So it's important to frame this as a function of how reasonable those multiples actually are. For example, if I take a slightly more conservative view and compress the range to 18x, 20x, and 22x, the weighted target price comes down to around $30, and the implied return drops to roughly 13.5% CAGR over 5 years. Still above market averages, but noticeably less aggressive. So ultimately, the conclusion here depends heavily on what you consider a reasonable terminal multiple for SoFi Technologies. But even under more conservative assumptions, the return profile remains relatively attractive. Now, moving on to the sensitivity analysis. Since this is also framed as a 5-year outlook, I'm flexing the key operational drivers, primarily revenue growth, profitability, and dilution. On the top line, I'm assuming a revenue CAGR of 18%, 20%, and 22% across the bear, base, and bull cases. In terms of profitability, net margins in year 5 come in at 19%, 22%, and 25%, which again reflects a meaningful step up in earnings power over time. I'm also explicitly factoring in share dilution, with share count growth of roughly 3.5% in the bear case and tapering down to 2.5% and 1.5% in the more optimistic scenarios, which is consistent with how SoFi Technologies has been operating recently. These assumptions translate into EPS growth of roughly 23.5% in the bear case, 30.6% in the base case, and 37.6% in the bull case. What's interesting here is that the bull case is broadly in line with long-term sell-side expectations, which are calling for around 38% EPS growth. Implicitly, that assumes a combination of higher profitability and lower dilution going forward. On the valuation side, I'm applying PE multiples of 20x, 23x, and 26x across the 3 scenarios. Putting this all together, the implied returns from today's price come out to roughly 6.9% in the bear case, 16.2% in the base case, and 25.4% in the bull case. If we reverse engineer this and ask what price would justify a 15% 5-year CAGR, the implied entry point is around $17.37, which is slightly below the current price. And if you require a higher margin of safety, say targeting closer to a 10% discount, that entry point moves down to roughly $15.64. So stepping back, the takeaway here is fairly straightforward. Based on this framework, the stock offers a credible path to mid-teens returns, with upside skew if execution comes through on both margins and growth. In other words, SoFi Technologies screens as attractive on a risk-reward basis, particularly if you're comfortable underwriting continued improvement in profitability and a moderation in dilution. So to wrap everything up, overall, the stock still looks undervalued based on my analysis. The growth potential is clearly there, and the long-term trajectory for SoFi remains very strong, both in terms of revenue expansion and improving profitability. That said, it's important not to ignore the significant share dilution we've already seen over the past years, which has been a real headwind for per-share value creation. But even after taking that into account, the setup still looks relatively attractive at current levels. I believe that if execution remains strong, and especially if the company delivers closer to the bull case scenario, the stock could easily double over time. So overall, this is a high-growth, high-variance opportunity, but with a clear upside skew if the fundamentals continue to play out. As always, this is not financial advice, just my own analysis. Thanks for watching.